What if I told you one of the most trusted dividend funds in America just had its worst year in 14 years? SCHD, with $68 billion under management and trading near 27, is now underperforming 90% of its peers, and investors are shocked. But here's the twist. This short-term pain could set up massive long-term gains. Let's start with the Fed. At the July 30th meeting, two governors broke ranks for the first time in 30 years, pushing for rate cuts. Inflation has cooled to about 2.1% headline and 2.5% core, meaning high-yield savings accounts paying over 4% are living on borrowed time. Once the Fed cuts, those juicy savings rates will vanish, but SCHD's dividend growth, averaging 12% annually, continues to build. So why the underperformance? SCHD is overweight in healthcare and consumer staples, sectors that lagged while tech soared. But the fund recently rebalanced, adding exposure to energy and staples, precisely the areas analysts expect to rebound as tariffs reshape markets. History shows sector rotations are inevitable, and when defensives come back into favor, funds like SCHD can rally 20 to 30% or more. Here's what most headlines miss. Last quarter, SCHD nearly matched its benchmark with a 2.27% return, and dividend-focused indexes actually outperformed the S&P 500. Analysts now see upside to around $30 to $35 per share, with SCHD's 14-year track record of 12% annual returns still intact. Meanwhile, institutional investors aren't panicking, they're repositioning. Data shows they're holding cash instead of fleeing to bonds, preparing for the next cycle. Major firms continue to rank SCHD alongside top dividend ETFs like VYM, VIG, and DGRO as reliable portfolio cores. So what's your move? If you need cash in the next 12 months, SCHD may not be right for you. But for long-term wealth builders, it remains one of the most compelling dividend plays out there. Consider balanced strategies, like mixing SCHD with broad market funds, treasuries, or growth stocks, depending on your risk tolerance. Here's the bottom line. SCHD isn't broken. At around $27 per share, with a 3.8% yield and strong dividend growth, it's positioned for when the Fed cuts rates and defensive sectors rotate back. The fundamentals that built wealth for 14 years haven't gone anywhere. The choice is yours. Follow the panic or follow the smart money preparing for the next phase. If you found this useful, hit like, subscribe, and stay tuned for more contrarian investing insights.